Welcome today Peter Thompson, who is a mortgage loan officer with the Bank of New Hampshire. Peter's been with the association a long time. He's been in the residential mortgage lending business for over 30 years. He is, according to his bio, the National Association of Home Builders' only green certified lender and certified aging-in-place specialist in New Hampshire and New England. And he can tell us a little bit more about what all that means in a moment. But we want to talk specifically about the business that Peter specializes in, and that is helping folks getting mortgages for homes that they want to build that are green or highly energy efficient. Talk about green mortgages. Information I think would be very helpful to listeners this morning. So, Peter, good morning and welcome.
Good morning, Kendall. Always good to be with you. Glennis, pleasure meeting you and being with you here today.
Before we get into green mortgages and green building and all this other stuff, Peter, I have a question for you. I noticed on your bio that you are with the Bank of New Hampshire.
That's correct.
The one up in Bedford?
Yes, that's where I work from.
Okay, explain. It's funny because we go by there a lot to get into Manchester. And I said to my husband, this was about a week ago, I said, Bank of New Hampshire? We used to have a Bank of New Hampshire.
Yes.
Peter, could you explain what happened there?
Sure, we certainly did. As a matter of fact, I used to work for the old Bank of New Hampshire as part of the acquisition and mergers that occurred in the 90s with People's Heritage Bank, which ultimately became became TD Bank.
Right.
And what happened was the name was defunct. The bank no longer existed about 15 years ago. And New Hampshire, Laconia Savings Bank has been around since 1831.
That's what it was.
We have made major growth spurts in the last several years, and we're located throughout the state. So it made sense for us to look at our branding, and it was an ideal name for us, the Bank of New Hampshire, because we truly are a community bank, and we do cover the whole state. We're mutual. And it made sense for us to acquire the name. And the best part was that it cost us nothing. The name, they let the name go. They didn't protect it. We came in, acquired the name. There was no opposition, and so we are now the Bank of New Hampshire.
Now, will all the Laconia Savings be Bank of New Hampshire?
We already are. We have been for 2 years.
Okay, because we have one, I think, in Milford. There was a Laconia Savings. That is now Bank of New Hampshire.
Yes.
That makes so much more sense, doesn't it?
Well, again, with this growing organization and its long history and covering the entire state, it is a great branding opportunity and very unique for the bank. Congratulations.
Yeah, it's awesome, and too bad for the others that dropped the ball and let the name go, because we got it now.
And it was free.
And it was free, right?
Yes.
So tell us about green mortgages and all this green building stuff.
Green is a broad term that has many meanings to many people. There aren't that many green lenders, obviously, and that's one of the reasons why I'm here today is to talk about green and how banks can become involved. It's a time has come.
Finally.
Yes, with all the cost of energy, people want to improve the quality of life. We want to renew energy, and that's what green mortgages is all about. 4 years ago, I helped create a mortgage program within our bank. I served on the Green Committee for the home builders, and for several years we talked about green financing and green products. And one of the big issues was finding a lender who would buy into it and adopt the methods and the terminologies and find a way to finance these projects. And I'm proud to say we were on a cutting edge and we're able to do that. And for 4 years now, I've been doing it quite successfully. So for green, some people are interested in the return on their investment and saving dollars in terms of energy. Others, it's renewable materials being used, local materials, helping the local economy, using things like bamboo for flooring.
Yeah.
And we also use geothermal, the high-tech things. Solar energy. So that's all part of green mortgages. And it's a simple mortgage. It just happens to have a green feature to it. It's standard financing. We give a discount for the mortgage, and we use Energy Star as a jump-off point for qualifying customers for this type of mortgage.
Very
So,
interesting.
Peter, let me ask. We hear often in our business about customers, homeowners, home buyers, potential, who want to build a home or buy a home that has those energy features that you just mentioned and more: geothermal, highly energy efficient like Energy Star or above. But yet they find problems with the fact that it's difficult to get it to appraise. Everybody knows that in the mortgage business, you've got to get the appraisal to work so that the sales price meets the appraisal, meets the underwriting standards, and so forth. How are you handling that in your bank in terms of those challenges that we hear about?
Well, that's a good question, because when I served on the Green Committee, we had many, many discussions about this very topic. And I finally said, look, we can sit here all day long and talk about green. Nothing will happen in the lending world until we find a way to add value to appraisals. The appraisers didn't know how to add the value, so they ignored it, and consequently, the appraisals never worked out. We never could reach the values because it is a little more costly to build these homes, but the benefits outweigh those costs, and the return is significant because the technologies have improved so much. So what we did was bring an appraiser on board on the Green Committee, and we talked about these things, and they got it. There are a few appraisers that got it, and they knew how to add value with the advent of something relatively new. It's only a few years old, which Kendall's aware of, and this is through the National Association of Home Builders. It's the HERS rating system, Home Energy Rating System. What they do is take the technologies and they project out what the estimated savings will be on an annual basis. They annualize it, capitalize it, and then add that value into the appraisal. The other key piece that was missing was the lender. Finding a lender who would adopt the technologies, understand what green was all about, understand that it had value, understand that it was a great financial, stable customer that would come to the table on these mortgages. And so our best hope has always been the community banks. They were more open. They think outside the box. They don't necessarily sell to Fannie and Freddie and all the other secondary markets, although we do. Most do. But we had our own portfolio loans. We made our own decisions, and I presented it to senior management. Within weeks, I had a green mortgage, and the underwriters also bought into it. They understood the value based on the scientific formula to prove out those values. That was what was missing before, because it was just guesstimates. They had no idea of what the value would be because they didn't know how to quantify the savings or the value in that type of mortgage. So we were able to bring that whole thing together. We adopted it. I've been doing it now for 4 years, and we've been quite successful. And knock on wood, I have not had a single construction loan fail on appraisal yet.
Now,
Congratulations.
Thank you.
Really, this is, it's like you said, green is very broad.
Right.
Sustainable, you have all sorts of
There's a lot of greenwashing. We need to be very specific, as Peter's talking about.
Exactly. Now, does this include refinancing? If I were to refinance my home because I'm putting in all new energy efficient windows?
Yes. Yep, we have a program for that. It's a regular refinance, or they can do a home improvement loan, depending on the size of the loan. If it's just windows, maybe $10,000, then we do a home improvement loan. Or if they have equity in their home and it's an older home, then we can do an equity line of credit, and it's quite simple. They will control their own funds and do whatever measures they want to increase the efficiency to what it can be. So it works out quite well. There's no additional cost. We actually discount the rates on these programs.
Wow.
Peter, when it comes to mortgages, as most people know, again, you have several ratios that are used when you're talking about qualifying. One is a loan-to-value ratio. The other is, of course, the ratios of income versus what the payments are going to be, whether it's principal, interest, taxes, and insurance. My question to you is, do you also add in, when you're talking about this special program, the cost of the utilities or maintenance of that house? If you're talking about green mortgage, again, historically, mortgage companies and banks have not given credit to reduced operating costs or reduced energy costs. Do you take that into account in your program?
Well, the way we look at it, it can be handled both ways. It can be handled, as you said, giving extra buying power on the ratios because it'll reduce their actual cost and thereby bring the debt-to-income ratios down. However, as a portfolio lender, we already do that. We extend the ratios out and beyond the normal secondary market or first-time home buyer programs. For example, FHA will go out 41% on a back-end ratio, which is the overall debt, and they can stretch that a little bit as well. We typically go out 45%. So it's already built in, regardless of whether it's green or not. We have that capability of extending the debt to income. So it's accomplished one of two ways. Either way works for us. As a portfolio lender, we normally do that anyways.
How much of your lending then for new home buying or new home building, either one, is targeted towards or involves first-time home buyers? I'm not talking about upper end. I'm talking about first-time or lower end to mid-size or mid-priced housing.
Well, we do quite a bit of first-time home buyer programs, obviously. There's a lot of first-time buyers, and we handle all the normal first-time buyer programs, FHA, New Hampshire housing, VA loans, rural development, or any combination thereof. So they are there. However, they don't offer green. They haven't adopted it, and I wouldn't look to them to do that right now. They're busy just handling the toxic loans that we're all dealing with today. For me, on the new construction lending, I would say in the last few years, 80% or more of the requests for construction lending have been Energy Star or better. And they've run the full gamut from the simple Energy Star all the way up to the total combination of geothermal, solar arrays, high energy envelopes, windows, air exchange, mechanical air exchange type of technologies, because these homes are so well built and so tight that they need, in some cases, they have a mechanical air exchange system.
I'm listening to all this, and what is the comparison to a conventional mortgage? Is the rates different? What is the benefit of a green mortgage?
Okay, it's not a secondary market loan because they haven't accepted any of this stuff yet. They may in the future. Who knows? It takes them a long time. But on portfolio lending, we have our own rates and terms. The rates are going to be a little bit higher.
Okay.
However, we can offer the product because we're bearing the risk. We're keeping the loan in-house. We're servicing it. And the customers like that a great deal because they're going to be dealing with a lender on a daily basis that they know, they trust, and they can just walk into the branch or any office and talk to an officer or anybody representing the bank to service them. So that's a big plus for us, and that's one of the benefits to the customer as well. So it's a product we can provide that nobody else is providing, plus we're providing the service that goes along with it and the expertise to do these on a regular basis.
Now, FHA used to have, did it not, what's called EEM, Energy Efficient Mortgage. Is that no longer available?
They do, but it primarily deals with existing housing. Mm-hmm. It's retrofits. Sometimes it's first-time buyers. Mm-hmm. and they will go up to 90% loan to value.
Okay, and some of your colleagues at Bank of New Hampshire handle that. You primarily don't do the
I
remodeling.
do,
Yeah.
I do, but I don't get much call for it. But that's another emerging market. Last year I did a $1 million house. They wanted to put in a $100,000 solar array, and the appraisal worked. We happened to hold the mortgage on it to begin with, but still it worked, and it was economical because we didn't have to do it as a full construction loan where there are added costs. He built the system on an outbuilding, so it didn't involve the actual home itself, and we were able to keep the costs down. We didn't have to have an inspector come in. We had the appraiser come in. So we find ways to save the customer money and make it economical and feasible for them.
So important because we're almost to the end of the segment.
Keep going.
So important, as we've talked before, Glennis, on this show, that New Hampshire has among the oldest housing stock in the country. Old housing stock translates into energy inefficiency. Therefore, homeowners spending so much money on heating, primarily other utilities. And so any way that we can encourage homeowners to do the retrofits, to do the energy upgrades, and provide them with incentives or good quality mortgage programs at work, that's what is needed, quite frankly. That is the highest order of importance that we have in the real estate and construction industry in the state.
And with that, Kendall, we're going to get back to that. I'm sitting in the pod with Kendall Buck, Peter Thompson. We're talking green mortgages, and we'll be right back to talk more about it. First-time homebuyers, millennials, they're big, very big on green, sustainable energy, all of that, more so than we ever were. How does these mortgages compare to first-time home buyers' conventional mortgages?
And what do you recommend for first-time home buyers?
Well, for the first-time home buyers, this is a real challenge, finding a program for them. Because they're just starting out and they have limited resources and they need the first-time buyer programs to get into a home, which means low down payments, high loan-to-values. Of course, they have to have all the good things too, like good credit to go along with it. But that's the real challenge because in the lending world, when you're dealing with government loans, these are sold to investors. Every bank has their own investors. Every bank has their own contract or agreement with that investor based on exposure, experience, things of that nature. And depending on who the investor is, the programs are national programs in many cases, rural development, VA, New Hampshire housing, that's a state program, but in the FHA, but the investors can layer on additional guidelines to these programs that they want to see in order for us to sell those loans to them, or they may not offer it at all. For our investor, they won't do new construction. They're not doing the FHA energy efficient mortgages. They don't do the 203K loans as well. So that's the dilemma, trying to find an investor who will go with the straight national guidelines for these programs. So for the millennials, which are very important, that's a difficult ground to break for the green construction. They tend to be a little more expensive, but the return on the investment is well worth it. But again, you've got to get the government lenders or the investors to buy into this stuff.
Is there any thought or discussions at Bank of New Hampshire for trying to search out new investors that can to head in that direction?
Well, I'm sure we're always looking for investors. We had, for a time, difficulty in keeping an investor for our government loans, and for about a 6-month period, we weren't able to offer any government loans because we couldn't find an investor that was willing to do it at the time. And it's all about risk aversion and management, and so we're always on the search for a good investor to increase our menu of products we can offer to people.
There you go, Glennis. You can be an investor.
Oh, yeah. I'll tell you what, I'll invest my home. Use it as a, right?
There you go.
You could use it as a good collateral here.
Exactly.
My question for you, though, Peter, is with going back to first-time home buyers and these millennials, because I have two. I've discussed this many times, and they're smart. They're savvy in the sense that they don't want to rent. They don't want to rent. They want to buy these brand new in Boston. They want to buy these new lofts here in Manchester. They're redoing all the mill housing. So they want the best, but they can't afford the best. Is there a loan for them to say, come in and buy existing homes and make them energy efficient, make them green? Because all of our home, like you were saying in New Hampshire, is, what did you say, Kendall, the statistic was, we're the state with the most?
Of all the states, New Hampshire is either 1 or 2 in terms of having the oldest housing stock in the state.
And a lot of young kids, they don't, they're not into antique. I love antique homes, but these kids are not into it. So they could buy an existing home and completely refurbish it with all energy efficient vehicles. Would they be better off doing that, getting a loan, a green loan for existing homes?
They can do that, and it all comes down to loan to value. Typically on a portfolio loan, we require 20% down, especially on construction. However, we have been able to look at doing a mortgage. If they can come up with 20%, I call it a purchase plus, where they look at the total acquisition, which is the cost to buy the house plus the cost of the improvements, up to about $30,000, which can go a long way to make some energy improvements, windows, new heating systems, insulation, things like that. So you take the cost of the improvements plus the purchase price, we can lend 80% of that figure.
Wow.
So we can finance some of those costs as well. So it's feasible to do something. And, typically you're replacing a roof, you're putting in a new heating system, you're upgrading the electrical, you're doing some insulation work, you're putting in windows, weatherization type things that we can do. And that's a portfolio loan.
But that's still a challenge for those who don't have the 20% down payment. That's right. That's the challenge.
That is the key. Oh. And what about the credit? These first-time home buyers, most of them are swimming in student loan debt.
Yeah, that's a big issue, and starting out. And that's where mom and dad can come in with a gift. I mean, they can come in.
Not this dad.
Not this mom.
I already paid mine. I did mine already.
I did my thing.
Yes. Sure. There's gifts. They can get a gift. They can come in with 10% of their own money. They can get a gift to help out. If they're buying a home, the seller can help contribute toward closing costs and prepaid items. Most programs 3 to 4%. With FHA, it's 6% toward the closing costs, so it can reduce their costs and make it more affordable for them. So that can work to their advantage. And they may be able to get a grant from some nonprofit as well.
There are opportunities out there.
Oh, there is. And
it is challenging.
We were talking several shows ago. We had somebody on addressing the issue of first-time home buyers for these specifically millennials. And the suggestion was, because rents today, I mean, these kids are paying $2,000 up to $3,000-$4,000 a month in rent. Okay, you add that up. There's your down payment.
Yeah, it's cheaper to buy a house than it is to rent.
That is correct.
Right. So if they can save that, maybe by moving back with mom and dad for a short period of time, you're finding that is happening an awful lot. Before we came on this morning, we were discussing a new report out, housing needs assessment. That is just the first part of it was unveiled this past week. Housing assessment done for the New Hampshire Housing Finance Authority. And that's one of the elements pointed out is that, student debt, high student debt is a big problem for the millennials, not having the down payment, and moving back to the parents' house. There's a lot of ramifications that result from that dynamic and demographic. So it is challenging for that group.
It is challenging.
Well, I recall when I went to college many years ago, more than I care to count.
We're right there with you.
Yes, well, same group. We've got to be careful because these millennials have to take care of us.
That's correct.
When I went to college, depending on what field you were in, when you came out of school, there was forgiveness. 10% per year.
That's right.
They need to bring something like that back, especially for community-type jobs like the medical profession, the teaching profession, and why not the building profession as well, because we're lacking the artisans.
That's correct.
Not everybody wants or should go to college, and there are those that are good with their hands and they have good minds, and they want to be in the trades. You know, we have to create opportunities through the trades as well. And that may be another field where they can forgive debt because they're serving the community. They're providing a needed service and product.
Well, that's a good segue, Glennis, into a topic that we'll bring to a future.
Absolutely.
Nailed it
Absolutely.
Segment in terms of workforce development for the construction industry. So that's something we're going to be able to talk about.
But going back to the first-time home buyer, the millennials, we also discussed buying these 2-family, 3-family, 4-family homes, these kids, you know, and renting out as part of their income, if they can do that. A lot of these 2, 3, 4-family homes are like in Manchester, here in Nashua. They need a lot of work.
Yeah.
So how would that maybe be? It's all creativity, I suppose. It always has been. Mortgages has been be creative financially, you know, with financial creativity. I don't know. I want to see these kids have an opportunity.
Well, that's a good question you pose, and I'll just build on it for Peter. Do you see a lot of, again, pick a simple duplex, young couple buying a duplex, being able to rent out half of it. Is that being done?
It is. It is. It is difficult, you know, when you're dealing with secondary market and government loans. There are a lot of restrictions, and the big thing is they want to see if they're going to be first-time buyers, if they don't have any experience in being a landlord, that won't work. Plus, they want to see 6 months reserves for PITI, and that's another difficult thing. Their first time out, they don't have the money.
What's PITI?
Oh, principal interest. I'm sorry.
That's okay.
That's banking technical jargon. Principal, interest, taxes, and insurance.
Gotcha.
So they can come in with smaller down payments, but the requirements are difficult because of the reserve, so they have to come in with a lot more money because they got to carry the reserves. And then with the income, they'll count up to 85% of that income to add back in to qualify them. It's feasible, but in those programs, they're looking for quality-type properties that don't need a lot of rehab. You know, a little bit of cosmetic is fine, but, you know, major things, they're not going to do it because it's too risky.
And there's probably not a lot of those properties around.
Now, what we do, it's not necessarily for first-time buyers. I don't know of any other lender that does this, but on new construction, owner-occupied will allow them to build a 4-family.
To build a brand new?
Brand new 4-family, yeah.
Owner-occupied.
Owner-occupied.
Or 2-family or 3-family?
2-family, 3-family, or duplex.
Up to 4.
Yes, we'll do that.
As long as all the numbers work.
Yep.
It's interesting. Again, I mentioned that housing needs assessment that reports are now coming out. One of the challenges we have in the state in terms of the way zoning ordinances, local zoning ordinances are set in terms of not allowing you to build that in-law apartment or daughter apartment, if you will. We talked about the large houses that many of us still own, and if we could have children come back and maybe take over the house, and then we as parents can rent or move into the in-law apartment, many ordinances don't allow that to be done. And so I think we're going to be looking at that to see if we can't foster some changes around the state to allow more of that to be done. It just makes sense.
Oh, absolutely.
And a lot of the challenges in housing right now is there's very limited inventory out there. And what is out there is older, as Kendall mentioned, and there is quite a bit of deferred maintenance. People are just busy trying to put food on the table and gas in their tank and oil in the furnace. So these houses are in need of work.
It's how quickly things change. We had that deep recession in the real estate business. Now the reports out from the realtors are that, again, the number of houses on the market, the inventory is so low that there's not much good inventory available for purchase. Certainly that is, from the home builder's perspective, good news because we want to build new houses, but we still have the challenges of the economics making it work.
And right now, some realtors I've talked to, if you're priced around $300,000 on a home, they're showing the house 25, 30 times with multiple offers and offers that are coming in higher than the listing price.
Above listing.
They're getting into bidding wars again.
Yep.
So it's pushing the millennials out further. And to back that up with the last 10 years, towns have been reluctant to allow growth and development. And so there's not as many subdivisions out there available and building lots to build houses. They're starting to come around now again and open that market up. But it was a big expense, and the legal blockades made it cost prohibitive where builders and developers didn't even want to get into a subdivision or start a subdivision because it was too costly, and they'd end up in court and make it so that it was not economically feasible. They couldn't make any money. So it created another situation.
We deal a lot with that in the Home Builders Association. Peter, I want to move quickly to asking you how things have changed since the recession, since Congress enacted Dodd-Frank. What's changed in your business? You've been in it 30 years. What are the challenges today that you didn't have? Are any good points come out of some of the new laws and regulations?
Well, it's, again, more regulations, 2,000-page law that went into effect. How do you enforce it? That's one thing. And what it's done is slowed down the whole process. It's made it more difficult because they're tightening up on the credit, the debt ratios, and they have a thing called QM, quality mortgages now, that we have to deal with. So that keeps mortgages within a certain range. And then, of course, portfolio lending, you can't go outside that. But now it's belt and suspenders again.
Is that not a good thing in terms of now lending money only to people who can afford it?
Well, it's
That's
good.
That's my editorial, by the way.
Yes, it's good to lend money to people who can afford it. And what a lot of the community banks did was that we didn't set people up for failure. We didn't do the interest-only loans.
Like the big guys.
Yeah.
Yes.
The stated income, I used to call them the ninja loans, no income, no job, no assets. But they have a...
Those were those no verification things, weren't
exactly,
they?
Right,
yes.
right.
Trust me.
Trust me.
Holy Toledo.
I put it down on paper, it's true, and that's it, and that's why we got in trouble. But there's a certain amount of regulation that's good, but also it tightens it up too. And what happens, a lot of good borrowers get punished as well because they're paying higher prices, higher fees, especially secondary market. They have a thing called delivery fees to manage risk based on credit tiering for scores, things like that. So it has its good points, it has its bad points, and it slows the process down. I will tell you, banks' compliance departments are growing exponentially, just getting their arms wrapped around things.
It's a job creation act.
It is.
In your business.
Yes, pretty much. So A lot of these things are we're starting to take effect in January, so it's going to be a while before we see how it all falls out and how it really impacts us.
So the other shoe has not dropped yet, you're saying?
As far as I can see, yeah.
Mm-hmm. Interesting.
It's we have to wait and see. Well, first we had to pass it to find out what's in it.
That's
right.
That's
There
his
you go.
editorial. That's Peter's editorial.
You got to dig deep.
Yes.
We have one.
Dig really deep.
What do you recommend for, again, say a young couple comes to you and say, we're just starting out. We don't know what's involved in getting a mortgage or getting qualified. What's the first thing you recommend that they do?
First thing I recommend is that they contact a local housing authority and go to a class to teach them how to be better owners, how not to fail, and what they need to do to prepare themselves for ownership.
Right.
So that when they enter that market, they have all the tools and all the information that they need to effectively look for a home and have confidence that they're headed in the right direction and they're going to be successful. And then also sitting down with a lender, spending a few hours with that lender. Let him walk you through the process. Let him counsel
education.
you. That's a big thing, is home buyer education. Right. That's a paramount thing with any loan. For anybody, sit down with the lender. Let him help you find out what you need. What you want isn't always necessarily what you need. And a good lender will show you the program that's going to best fit your needs.
Good advice. Again, it's all about home buyer education, and one of the best sites to go to is gonewhampshirehousing.com.
Right, and that was Ignatius, right?
That was set up by the New Hampshire Housing Finance Authority. Tremendous amount of education on there, doing what Peter's talking about in terms of meeting with a lender advisor to get pre-qualified, to learn that process, and then the full education of what's involved with being a homeowner. Yes, you have to pay some taxes. Yes, you have to do some maintenance. You have to have money set aside for this. Somebody's got to shovel the driveway. It does snow here in New Hampshire.
You got to have food on the table.
Yep.
All of that. Home buyer education is so very important.
And it's free. It's free advice, correct?
Oh,
if
absolutely.
They go up there.
Yep, absolutely.
It's the world of the millennials right now, and we being the baby boomers. Okay, we're aging. Okay, a lot of us were very affected by the economy. A lot of us have been. So now our kids are looking to us. Remember the days when we could go to Dad and say, could you, I need, we were trying to get a down payment to get. Us dads and mom don't have it this time. We don't have it. We're the baby boomers that got affected by this whole economy. So we can't help these kids like we used to. Is there such a thing as co-signers on a mortgage anymore?
Oh, yes. There's still co-signers.
They're still there.
Is that
okay.
done quite a
Dad
bit?
Can go on the hook. Yeah. Oh, yeah. Yes.
But
they can still
the
go on the hook.
criteria,
Yeah.
what is the criteria? Say I want to be the co-signer. What's the criteria for the co-signer?
Well, they're going to take your income and your debts into consideration and your credit score. And, you're a non-occupant co-borrower. You're wholly liable as well as the kids. So if they screw up, your credit's affected too. So it's a big responsibility. But kids are less likely to default on that because they're not going to let mom and dad down.
True. But first they got to pay off their student loans.
Well,
Is that taken into consideration with these first-time home buyers?
Well, with student loans, it used to be that with certain government programs, they'd allow the deferment so that they didn't have to count them when they were qualifying them for mortgages. Now they're counted, whether you're in deferment or not. So that's a killer. I believe VA is the only one that still allows the deferment. So if they're in deferment for at least 12 months, then we don't have to count that debt. But you add that in, that could kill the deal because of debt to income. But also, it's real debt that they're going to have to deal with.
That's right.
It's deferred now, but they're going to have to pay that
That's
loan back,
right.
and we don't want them to fail.
So they got to pay the loan off. I
Yeah.
mean, you're getting two young millennials together. They got married. They want to start their future together, have kids if that's what they want. They're both coming in. Some of these kids have $100,000 in student loans.
Oh, easily.
So combine that. That's $200,000.
What is happening is delaying their home purchasing.
Oh, it's a shame.
I mean, my own daughter is a case in point. They did not buy their first house until they're in their early 30s. We bought our first house when I was just out of college, 23 or
Right.
whatever it was. And so that's this delaying home purchases. I think you're finding a delaying of creating, families and that sort of thing. So it is different nowadays.
Oh yeah.
It is different.
Yeah, and is it getting? Do we see? Is the housing market? Are you seeing, Peter? Are we on an uptick?
It's been soft, but there's good signs out there. Rates are staying down. People are starting to look again. And, of course, I think a lot of this soft market had to do with the weather this year.
True.
Extremely tough. This is one of the first few nice days we've had all year. And it's good to see the snow gone. And even construction is backed up probably about a month now. Normally we're breaking ground at this time for new projects. Be lucky to break ground by the end of May. Hopefully we'll have a short mud season. But again, it's getting there. The prices are stabilizing as far as value, appraised value, starting to stabilize, which is a good sign. And of course, we're seeing some uptick in the sale prices, but again, that's because of limited inventory. We need more
supply
inventory.
and demand.
Yes, we
We
need more
need to be
inventory.
able to build more housing,
Come
get
on,
more
guys.
supply.
Work it out.
One of the problems, again, a number of years ago before the recession in New Hampshire is that the supply was so constricted and the demand was so high that, Economics 101 kicked in. New Hampshire was among the least affordable in terms of housing cost in the entire country before the recession. We don't want to get back to that point.
And
No.
on that note, we're coming to the end of the show. Peter, how can we get in touch with you? Tell our listeners how they can get in touch with you at Bank of New Hampshire.
Well, they can call me directly at 603 707 2870 on my cell, or my direct number, 527-7201. You can go to the bank's website, www.banknh.com, or my website, thompsonp@banknh.com.
Terrific. We nailed it again, Kendall.
We did
We
indeed.
nailed
Thank
it.
you.
This is a good one, which
Thank
we're going to
you.
have to continue. Kendall Buck, New Hampshire Home Builders Association, thank you so much. I am Glynis, and we will see you back here next week. Have a great one.